Right, let's have a look at part 3. Calculate. Look at this, guys. Calculate. Not present, not disclose. Calculate the deferred tax balance, therefore one amount, in the statement of financial position of ChocoCoffee Ltd. as at 31 December 20.11 using the statement of financial position approach. Your answer must comply with the requirements of IS 12. Note, show all calculations, round all calculations to your nearest rand. As always, I want you to think about your plan of action. My first step, I will include my deferred tax calculation template. Now, what is this? On a new page, indicate that this is question 1, part 3, and you include a table. Carrying amount, tax base, temporary difference, and deferred tax. Quickly recap. What is your carrying amount? This is in terms of your accounting rules. Tax base is your carrying amount for tax purposes. Temporary difference can either be a taxable or a deductible temporary difference. Deferred tax can be a deferred tax asset or a deferred tax liability. This is all included in that YouTube video that I have mentioned a few times. Right. Step number 2, work through your information from the top, through your assets. Now, we're able to remember that we have our machine, remember, which we have covered in part 1. We have our PPE, which consists out of our land and our building, and our machine, which we've covered in part 2. And we have our investment property, which consists out of land and building, but we have not yet calculated anything in terms of our investment property. Then step number 3, complete your deferred tax calc. Sorry, I've just missed something that I wanted to indicate to you. Focus on your easy marks. Your easy marks here will be your carrying amount, because you have already calculated the carrying amount of your machine in part 2. You've calculated your land and your building's carrying amount. We've not yet looked at investment property. Okay, so new page. Sorry guys, not your PPE notes, your template. This will be your template. I know there is amounts included already, but imagine there is no amount yet. Right. Now, if we look at the information provided and we work briefly, remember we have looked at this in detail already. If we look at the information provided briefly, remember we have our machine, right? Therefore, we now need to determine the carrying amount of our machine. This is our easy mark. We've already calculated this in part 2. Therefore, if we refer to our part 2, now PPE note, you will be able to identify that the carrying amount of our machine is 27581. Therefore, let's immediately transfer this. If you look at the left side, roasting machine, we have our 27581. Pretty straightforward, right? Then, next, if we look at our processing plant, we know that we have our land and buildings as a 2. Land, very important, I've indicated to you on the revaluation portion, we have to tax this based on CGT rate. Therefore, my recommendation, the way that I normally do this, is I will include 2 line items. If I look at land, I will include my cost portion, which will be the 1 million. I will include my revaluation portion, which will be the 250,000. Together, this will be the 1.2 million. I just want to move this there. Yes. Right. Then, in terms of my building carrying amount, we've already calculated this in part 2. You look at our building part 2, 1925000. Yes, pretty straightforward. 1925000. I prefer to just indicate to my marker that this is from my Part 2, PPE note. Part 2, PPE note. Right. Now, if we refer back to our given information, the office block, they've indicated to us purchased at a cost of 600,000 and 1 million. We have a fair value at year end of 700,000 and 1.350000. Therefore, if you refer to the explanations, again, I prefer to include my timeline. Our initial recognition 1 March 2011, our year end 31 December 20.11. Cost of our land 600,000, building 1 million. At year end, land 700,000, building 1350000. For if we now look at this, our land has increased with 100,000. Our buildings fair value increased with an amount of 350,000. And when you look at the journals at the bottom, remember on initial recognition, we will debit our investment property land, investment property building with 600,000 and the 1 million. We will credit most probably bank, I assume, right? Now the property increase, you look at the right side, we will debit our investment property land, investment property building, credit fair value adjustment with 100,000 and 350,000. But this fair value adjustment, remember guys, tax at CGT rate. Okay, therefore, next, if we now look at our office building, again, I prefer to include this as a separate line item. I will include my cost. My cost will be the 600,000. My fair value adjustment will be the 100,000. Together, this will be 700,000, right? The same in terms of my building. My building will have a cost. Sorry guys, I just quickly want to take this out here because my space is a little bit limited. Okay, but I need to indicate where did I calculate this. This is my PPE note, part 2, right? Now, if I look at my building, I will have a cost of 1 million. I will have a fair value adjustment of 350,000. And together, that will be the 1350000. Right. I have now transferred all of my easy marks, which is my carrying amount in terms of my accounting rules. Now let's have a look at our tax base column. Our tax base will be the carrying amount in terms of our tax rules, right? Right, now if we look at our tax base, you will remember that they've provided to us information in terms of our tax allowance. Now, I'm just quickly going to read through this briefly with you again. The South African Revenue Service allows the following capital allowances. Remember, we've identified that this relates to our tax base. An annual allowance of 5% on the processing plant, according to Section 13(1) of the Income Tax Act, on the straight line method, not proportioned for a part of the year. A tax allowance on machinery in terms of Section 11(e) of the Income Tax Act, on the straight line method over 6 years, proportioned for part of the year, which we have explained previously, right? Proportioned and not proportioned. Then, there is no capital allowance granted on the administration buildings, right? Now, if we take this one step back and focus only on the processing plant land, what is the tax base of an asset? Tax base of your asset will be the amount deductible in future for tax purposes. If we look at the cost value, this cost. What will the tax base be of the cost value? Now I've identified that they still make use of the word exempt, which I don't agree with, but okay. They indicate that the 1 million is exempt in terms of IAS 12 paragraph 15. But if you think about this, if we sell the land in future, we will be able to deduct that 1 million. Therefore, our tax base will technically be 1 million. You just need to remember that this will be exempt for FAC 3702. In terms of the 250,000, what will our tax base be? 0, because this is an accounting entry, not a tax entry. Now let's move on to our building. We have our carrying amount. We need to calculate our tax base. They've indicated to us at 5% per year. And if we look at the information, 5%, not proportioned for part of the year. Therefore, not proportioned for part of the year. We're able to remember that our cost is the 2 million. Therefore, divide this by 20 or times 5%, and this will be 100,000. Therefore, deduct 100,000 for 2010, and then deduct another 100,000 for 2011, and this will be 1.8 million. This is the carrying amount for tax purposes. Therefore, in future, we will be able to deduct the 1.8 million based on our tax allowances. Right, now let's refer to the office block land. If you look at this, the land, we have our cost of 600,000. Again, similar principle as per processing plant land. Exempt difference, 600,000. This is a rule, guys. You just need to study this, please. The same in terms of our building. 1 million is exempt. In terms of the fair value adjustment, do you agree with me that this is an accounting entry, the 100,000 and the 350,000? Therefore, there will be no tax base. Now, let's have a look at our roasting machine. What is the tax base of our roasting machine? 25075. But how did we calculate this? We use our cost, which is 30090. Divide this by the 6 years. And we are able to deduct, I just want to get the amount here, guys. It is provided to us, 5015. Therefore, my tax base will be 30090 minus 5015, and our tax base is 25075. Right, 25075. Okay, we need to indicate to our marker how did we calculate this. If you look at the right side of your screen, I'm going to include that this is my calculation number 1 and this is my calculation number 2. Therefore, calc 1, calc 2. Okay, now next column, look at your temporary difference. Remember, your temporary difference will be the carrying amount of your asset minus your tax base, or in this template, your exempt difference. If it's exempt, remember, no tax. Therefore, our temporary difference of our processing plant, the land, will be the 1.250000 minus the 1 million, and this is 250,000. The same with our building, 1.950000 minus 1.8, and this is 1.250000, and so forth. Now, what I want you to be able to identify from this is that these are all taxable temporary differences. Therefore, a taxable temporary difference will result in a deferred tax liability. All of this is explained in that video, and this is rules that you need to study and know. Now, another set of rules that you need to add here. If we look at land, and I'm going to make use of pink for you to be able to follow me. The tax rate will be CGT. Remember, I've indicated to you that when we sell the land, we will recover. If we sell, capital gain. If you look at our office block land, CGT. If you look at our office block building, CGT. Why? In this scenario, they've indicated to us. Remember that? I just want to get that section there, guys. Temporary differences, unused building. I think it is here. Will be recovered. At the bottom of your screen, guys, investment property will be recovered through the sale. Therefore, we know CGT. Right. Again, this is a bunch of rules that you need to know. Land, CGT. Investment property, the fair value adjustment, CGT, CGT. Our building, we will use. Therefore, if we use the building, this is at 28%. If we use the machine, the recovery is at 28%. And this will result in deferred tax liabilities. Why? Because the carrying amount of your asset exceeds the tax base. If the carrying amount of your asset is greater than the tax base of your asset, this will be a taxable temporary difference. A taxable temporary difference, and this will result in a deferred tax liability.